Let us move towards the other deductions. So the next one in line is deduction in respect of medical treatment. Section 80DDB. What we have learned yesterday is section 80DD, wherein a fixed amount was given as deduction in respect of disabled dependent. Here it is about the medical treatment of dependents and the individual himself in respect of certain set of diseases, certain set of chronic diseases or some deadly diseases which where the assessee incurs a expenditure, he can claim that expenditure under section 80DDB. Now again, this section is applicable only in case of individuals and HUF. Individual for medical expenditure of himself or his dependent, or a member of HUF when the HUF incurs any expenditure on the medical treatment of the member. Now, who's a dependent? In case of an individual, dependent is spouse, children, parent, brother or sister, wholly or mainly dependent on such individual. Understand, it is only the dependent relative who is covered here and not an independent one, because if at all a person, if at all an individual is independent, he can claim this expenditure in his own return of income. So we are talking of a dependent relative and comprising of spouse, children, parent, brother or sister. In case of HUF, it is the member who is dependent on the family. The amount of deduction is 40,000 rupees. So in case of medical treatment where the amount paid is exceeding rupees 40,000, it would be restricted to 40,000. If the medical treatment expenditure is lesser than 40,000, in that case the actual expenditure made, actual amount paid would be available as deduction. So unlike 80DD wherein whatever you pay you get a fixed sum of 75,000 or 1,25,000, here you get deduction only for actual expenditure. However, if the expenditure on medical treatment is done on a senior citizen, now senior citizen is defined to be a resident individual who has attained 60 years or more of the age at any time during the previous year. So if the medical expenditure is done on a senior citizen, in that case the deduction would be that of 1 lakh rupees. Maximum deduction capped at 40,000 or 1 lakh. In case if the dependent is a senior citizen, it is 1 lakh. For all other dependents or the individual himself, it is 40,000. The condition to claim this deduction is that the assessee should obtain a prescription. Now you have to obtain a prescription of medical treatment from a neurologist, oncologist, urologist, hematologist or a immunologist or any other specialist. So it is basically disease which is concerned with either the mental state of a person, or oncologist who's dealing with malignant cancer, urologist kidney and renal function, hematologist wherein a doctor who takes care of the blood issues of a person. Basically it is all diseases are complex diseases. They've been notified under rule 11 DD. Rule 11 DD of the income tax rules, wherein the diseases have been prescribed. Thereafter, so similar to when you look at 11 DDB, you find that there is another section that was covered yesterday, section 80D, wherein medical expenditure was allowed as deduction under section 80D as well. But that expenditure was allowed in case of a senior citizen who is not covered by an insurance policy. There, the diseases are not prescribed. Any medical expenditure that you incur would be available as deduction under 80D. Once you claim an expenditure in any of the section, you are not supposed to claim it under any other section of the chapter 6A. So if you are claiming deduction under 80D, you are not claiming the same amount of expenditure under 80DDB. However, both of them could be claimed simultaneously if at all the expenditure incurred goes above the threshold limit. Next is deduction in respect of interest on loans taken for higher education. What the entire intention is to promote higher education of an individual. So if at all he takes a loan, an education loan for the purposes of pursuing higher education, the interest thereon would be available as deduction under section 80E. So whatever he is taking for educational purposes would be allowable as deduction, provided such loan is taken for his own education or spouse, education of spouse or children. So if a loan has been taken by individual for higher education of spouse and children of that individual, in that case he can claim deduction under section 80E of the Act. Higher education would mean, any education after 12th, even the CA course would fall under higher education. Anything after 12th, it is not necessary that you must be taking education only in India. You can take education anywhere across the world. The loan taken should be for higher education. That is the only condition we have got. The amount of deduction, there is no cap on the amount of deduction. The entire interest paid by the assessee would be available as deduction. The period for which such interest is available is 7 years. 7 years plus starting from the year in which the assessee starts paying the interest on education loan. The moment he starts paying interest, sometimes what happens, there is a gestation period which the banker gives. So he doesn't start paying interest immediately after taking the loan, because he'll have to first complete the education and thereafter start repaying the loan. In those cases where whenever the assessee starts paying interest, he can claim deduction in that year, in the year in which he starts, plus 7 years immediately succeeding the initial assessment year. So when you look at it, the overall period for which the interest could be claimed as deduction would be 8 years, including the initial year. The loan got to be taken from financial institution or an approved charitable institution. If all the conditions are satisfied, what you can do is you could claim deduction under section 80E in respect of interest on loan taken for higher education. Thereafter, loan taken for housing purposes. You have already seen deduction under section 24B, which dealt with home loan. Interest on borrowed loan for acquisition or construction of house is also available under section 24B of the Act. Now 24B of the Act is subjected to 71(3)(a). So you dealt with this also, wherein you saw that set off is available for a loss under the head of house property only to the extent of 2 lakh rupees in a year. Now in case of an eligible assessee being an individual who takes loan for acquisition of a residential house, so it covers, this 80EE covers a situation only in respect of acquisition of a residential house property. It doesn't take into consideration the construction of house property. So if the loan is taken for acquisition of a house property from any financial institution, interest payable on such loan would qualify for deduction even under section 80EE. So you are claiming deduction under section 24B. What you could do is you could claim a collateral deduction under section 80EE. However, the amount that you claim under 24B is not available as deduction under section 80EE. The conditions to be satisfied for availing this deduction: Well, there are four conditions that you got to satisfy. One, the assessee should not own any other residential house as on the date of sanction of the loan. So if an assessee has already got a house property and he is buying another house property, ATEE is not available. So essentially what happens is it is available only for the first time buyers. The idea is to facilitate assessees who do not have an house to purchase their residential house. And the next condition is that the value of the house should be less than or equal to 50 lakhs. It means it should not be exceeding 50 lakhs. So basically, it gives a relief to a middle class assessee who is buying his first house. The value of house should not exceed 50 lakh rupees and the loan sanction should not exceed 35 lakh rupees. The maximum loan for which ATEE could be claimed is 35 lakh rupees. Now, there is a condition in respect of the period in which the loan is sanctioned. So, period in which loan is sanctioned should be previous year 16-17. Note, it is the date of sanction of the loan that is important and not the date of disbursement of the loan. So, you could have, taken a disbursement of the loan at any point in time, but it should have been sanctioned during the year 16-17. How much is the deduction that you could claim? The maximum amount of deduction that you could claim under ATEE is 50,000 rupees. So any interest that you pay over and above, what you claim under section 24B, you could claim under section ATEE. The maximum deduction would not go beyond 50,000 rupees under section ATEE. Until what time can you claim this deduction? Well, you can claim this deduction until the time your loan repayment continues. So till the point in time you're charged interest by the bank, you can always claim the deduction under section ATEE. The reason why we are taking this, although the loan was sanctioned in 16-17, is because what could happen, a loan was sanctioned in 16-17. It is usually a long-term loan. A home loan is continued for 15 years, 20 years. So if it is so sanctioned in 16-17, you could continue to claim deduction until the loan period continues. Now the loan should be taken either from financial institution, being a banking company, or a banking institution, a bank, housing finance company. If you're taking it only from the eligible institution, could you claim deduction under section ATEE? So if you are taking a loan from a private person or an employer, that is not covered under section ATEE. It is only a banking company loan which is covered, or a housing finance company. So HFC, if you're taking it from HFC, it's fine. You could claim additional deduction of 50,000 rupees for loan sanctioned during financial year 16-17. A similar provision was brought in for the year under consideration, for the year which we are dealing with. Section ATEEA was introduced for all loans sanctioned during the previous year 1920. So specifically for loans sanctioned during 1920, taken by an individual, so similar to ATEE. The reason why this was again introduced with some different set of condition is to promote the housing sector again. The individual should not own any residential house if the conditions are similar to the earlier section we saw. It should be the first time buyer who would be eligible for a deduction over here under section ATEEA, and the deduction is again available only in case of an individual, so not available to an HUF. Loan for acquisition of a residential house to a first time buyer, and the conditions have been changed. A bit of change in the conditions. Stamp duty value of the house. So we are now concerned. See, if you remember the earlier section, it was the value of the house should not exceed 50 lakhs. Here the stamp duty value of the house should not exceed 45 lakhs is the condition. So 50 lakh brought down to 45 lakh. There is no condition regarding the amount of loan. In the earlier section, we saw that the amount of loan was capped at 35 lakhs. So if a person took a loan exceeding 35 lakhs, he was denied the benefit of 80EE. However, here no such condition in respect of loan is provided. What is provided here is only the stamp duty value. Stamp duty value should not exceed 45 lakhs and the loans should be sanctioned. Again, we are concerned with the date of sanction. So you could always have an adjustment like this, wherein the date of sanction and the date of disbursement is given, and the date of disbursement would always succeed the date of sanction. And what could happen is the loan is sanctioned in the financial year 18-19, however disbursed in 19-20. So probably that could lead to a confusion whether this particular deduction is available or not. If at all, if at all it is sanctioned in 18-19, no deduction would be available under section 80EEA. The sanction should happen during the previous year 19-20 only. Even if you avail a loan in the subsequent year, even if the disbursement happens in the subsequent year, yet the deduction would be available under section 80EEA. So again, the period of benefit would be till the date the repayment continues. However, in this particular section 80EEA, you're getting a advantage of 1,50,000. The total amount of deduction which can be claimed under this particular section is 1,50,000. In the earlier section, it was only 50,000. So an enhanced deduction is allowed in respect of eligible house property to a first-time buyer who is an individual. Well, a similar limit is also provided, as far as rupees 45 lakh is concerned. It is also provided under the GST rules, wherein rate of tax for a PMAY is 1% for houses below the, for affordable houses having a value of less than or equal to 45 lakhs. So similar extension you find in the Income Tax Act. However, you can claim a deduction here of rupees 1,50,000 over and above. This is going to be over and above the deduction that is already available under section 24B. So if when you pay in respect of a self-occupied house property, while you're acquiring self-occupied house property and you're paying interest of more than 2 lakh rupees, what you could do is 2 lakh rupees is something you could claim under section 24B and the remaining part you could claim under section 80EEA. So in case of let out or deemed to be let out property, well here, why do I talk of let out or deemed to be let out house property? The reason being, the only condition is that the person should not own any other residential house while he is taking a deduction under 80EEA. It is not necessary that the house should be used for his own occupation. He should be a first-time buyer. That's the only condition. So if we let's it out, there is no limit for 24B, but then you are aware of the limit provided under section 71(3)(a). So you cannot set off more than 2 lakh rupees of a loss. So what you could do is you could plan it this way. You could claim a loss up to rupees 2 lakhs under the head of house property, and the remaining amount you could transfer to 80EEA. So you could claim a deduction under 80EEA along with 24B. It's a good tax planning tool available. Well, if you claim deduction, do remember, if you claim deduction under 80EEA, you are not going to claim the same deduction under section 24B, or vice versa. If you claiming deduction under 24B, you're not going to claim the same amount as deduction under 80EEA. Again, here also the loan should be taken from only the eligible financial institution and the housing finance company. Let us take up an example. Look at this. Mr. A purchased a residential house property for self-occupation. So what we have here is self-occupied house property at a cost of rupees 45 lakhs on 1st of April 2017. Look at this. So it has been purchased during the financial year 17-18. We have dealt with two sections, 80EE and 80EE. Now this deals with, purchase of a residential house or, borrowing done in 1920, financial year 1920. 80EE deals with 16 and 17. We have got information of 17 and 18. Let's check it out further. In respect of which he took a housing loan of rupees 35 lakhs from a bank. So he's taken a loan of 35 lakh rupees. It doesn't exceed 35 lakhs. At the rate of 11% per annum. On the same date, the loan was sanctioned on 20th of on the same date. On the same date means on 1st of April 2017. So he's taken not only the house on 1st of April 2017, but the loan was also availed on 1st of April 2017. This information is critical here. What it says is the loan was sanctioned on 20th of March 2017. You've a sanction that has happened on 28th of March, and therefore the loan was sanctioned during 16-17. Now 80EE would come into play because we have got a sanction during the financial year 16-17. We are concerned with the date of sanction. That is what I was trying to emphasize. Compute the eligible deduction in respect of interest on home loan for AY 2021 under the provisions of the Income Tax Act, assuming that the entire loan was outstanding as on 31st of March 2020 and he does not own any other house property. So this is the only house he has got. The entire loan of 35 lakh rupees is not repaid by him. So you've got 35 lakh rupees of loan, 11% of interest. Therefore you understand that 3,85,000 rupees is what he has paid as interest. What he could claim maximum under section 24B, he could claim a maximum of 2 lakh rupees since the loan is taken for acquisition of a house property. And now, you have got 1,85,000 rupees of excess interest. Now that interest, out of this interest, what you could do is you could claim 50,000 rupees under section 80EE. Had the loan been sanctioned during 1920, he could have claimed 1,50,000 rupees entirely under 80EE. Yet he would have, unutilized interest of 35,000 rupees. But in any case, this deduction available during financial year 1920 would be 2 lakh rupees under 24B and 50,000 rupees under section 80EE. Restricted to 2 lakh rupees for 24B, and as far as 80EE is concerned, the restriction is 50,000 rupees. Let's move on to the next set of deduction, and that is 80EE. In order to promote electric vehicles, in order to have a vehicle that is driven by clean energy, and we have to reduce the pollution, and therefore 80EEB is introduced. And 80EEB provides for all the loans sanctioned between 1/4/19 to 31st of March 23. So a 4-year timeline is given, wherein what you can do is you could borrow a loan in order to purchase an electric vehicle. So something like a Tesla S is what you are purchasing. So if an individual purchases an electric vehicle and he takes a loan for purchase of such electric vehicle from any financial institution, now these are prescribed financial institution, will go to it. Interest payable on such loan would qualify for deduction under this section, the entire amount of interest. So you take a loan to buy an electric vehicle and the entire amount of interest you could claim under section 80EEB. Now you would say that, in respect of a vehicle purchased for business, you already have a section wherein you could, where the interest on borrowed capital under section 36(1), you could claim it as deduction. Yes, whatever is claimed as deduction under PGBP would not be available as deduction again under 80EEB. You can claim deduction under 80EEB only in respect of that amount of interest which you have not claimed anywhere else. Now the following conditions got to be satisfied. One is the loan should be sanctioned during 1/4/19 to 31st of March 23. The loan should be taken from a financial institution specified NBFC. The assessee should be an individual. What is covered under 80EEB is only individual. So see where it would be more of a use in case of a salaried employee who is buying a motor car or a electric bike or any electric vehicle for that matter, and he takes up a loan. What he can do is the interest that he pays on that particular amount, he can claim it as deduction under section 80EEB. The benefit of deduction under this section would be available from AY 2021. So this is new to the Income Tax Act and applicable from the year which we are discussing. So a new provision may be a little important, and subsequent assessment year till the repayment of loan continues. So similar to 80EE or 80EEA. Here also the deduction would continue until the time you repay the loan completely. Interest payable subject to a maximum of rupees 1,50,000. So you have got a cap here of 1,50,000. Not more than 1,50,000 could be claimed as deduction under section 80EEB. Here we have got some more financial institutions covered. What they say is it could be a banking company, any bank or a banking institution referred in the Banking Regulation Act. These two were anyways covered under 80EE and 80EEA. So we've got it covered again under 80EEB. Any deposit taking NBFC, now this is a new entry, so any NBFC, non-banking financial corporation, which is allowed by the RBI to accept deposit, even if you take a loan from such NBFC, it would be eligible for deduction. The interest amount of a systematically important non-deposit taking NBFC would also be eligible for deduction. Non-deposit taking, but then it has got a good net worth of more than total assets of not less than 500 crores. So more than 500 crores of total assets. It's a systematically important NBFC. So if you're taking loan from any of these organizations, you could claim deduction under section 80EEB in respect of loan taken for purchase of an electric vehicle. Now what is an electric vehicle? This electric vehicle is powered exclusively by electric motor whose traction energy is supplied exclusively by traction batteries. So basically a battery driven vehicle, and it should have a regenerative braking system. So if it's a modern day electric vehicle, all of them, they comply with these norms. If you're taking a loan for electric vehicle and buying, and paying interest on such loan, it would be available subject to a maximum of rupees 1,50,000. There is a cap on the amount of deduction. Let us take an example, small example here, and understand the concept of 80EEA and 80EEB. Now the date of sanction, a loan taken by Mr. A of rupees 43 lakhs. Loan is taken from a housing finance company. In a housing finance company giving loan for electric vehicle, that is not allowed. However, housing finance company giving loan for acquisition of a residential house, covered. Date of sanction is 1/4/19, that is 1920. So sanction is during the year 1920. When you compare this with Mr. D here, sorry, not D. Okay, see, if the loan would have been sanctioned prior to 1/4/19, if the loan was sanctioned, like in case of D, it was sanctioned on 30th of March. If the loan was sanctioned on 30th of March 2019, no deduction would be available because the loan is sanctioned during the year 1819. So here, but then as far as the problem goes, it is sanctioned well within the financial year 1920. The disbursement takes place on 1st of May 2019. Acquisition of residential house property for self-occupation. It says it is the loan is taken for acquisition of house property for self-occupation. The stamp duty value of the property is 45 lakhs. We are again concerned here with the stamp duty value. It is not, it does not exceed 45 lakhs, and therefore it satisfies all the conditions which are required for deduction under section 80EE. Now, therefore, what would be the amount of deduction that one could claim under 80EE? The rate of interest is 9% per annum. See what it is asking, compute the amount of deduction, if any, allowable under the provisions of the Income Tax Act. So what he can claim here is, deduction under section 24B as well as 80EE, because he seems to satisfy all the conditions. So in case of Mr. A, therefore, deduction would be under section 24B, 43 lakh rupees is the loan amount. See, the stamp duty value was 45 lakh rupees. As far as the loan amount is concerned, there is no capping on the loan amount. 43 lakh rupees have been taken as loan by Mr. A. 11% of this is the amount of interest paid. However, the disbursement has happened on 1st of May. So he has used the loan only for 11 months. Therefore, 43 lakh rupees multiplied by, sorry, it is not 11%, it is 9%. 9% is the rate of loan. So 9% of 43 lakh rupees for 11 months. Right, so that is the amount of actual interest paid. So we come to know that the actual interest paid is 3,54,750. Out of the 3,54,750, 2 lakh rupees, since it's a house used for self-occupation, 2 lakh rupees could be claimed under the head of house property under section 24 clause B. The rest of it could be claimed under section 80EE, right? However, subject to a maximum of rupees 1,50,000. See, out of 3,54,750, that was the amount of interest paid by us. 2 lakh rupees has already been claimed. Remaining 154 could be claimed under section 80EE. However, the maximum limit is 1,50,000 under the section, and therefore your deduction is restricted to 1,50,000. Now, in case of Mr. B, see what happens. In case of Mr. B, the loan taken is of 45 lakhs. It is a deposit taking NBFC. Well, in case of 80EE, deposit taking NBFC is not an eligible institution. Since it is not an eligible institution, the amount would not be deductible under 80EE. However, you can always claim deduction under 24 clause B. There is no bar as far as whoever you take the loan from, you can claim deduction under 24B, but not under 80EE. The date of sanction of the loan was 1/4/2019. Date of disbursement is again 1/5/2019. Here the stamp duty value also doesn't qualify. The stamp duty value is 48 lakhs. So even if you would have taken it from a bank, we still would not have given him the deduction because the stamp duty value exceeded 45 lakh rupees. So 80EE is clearly not available in case of Mr. B. The maximum deduction would be 2 lakhs in his case. The maximum amount of deduction in case of Mr. B is going to be 2 lakhs. No deduction is available in respect of loan taken by him from an NBFC. And see, there are two contraventions of 80EE. One is it is not taken from specified financial institution. Two, the stamp duty value exceeds 45 lakh rupees. Then in case of Mr. C, he has taken a loan from deposit taking NBFC of rupees 20 lakhs, the date of sanction is 1/4/2019. That is 1920 is the date of is the period in which the loan is sanctioned, financial year 1920. So he qualifies the condition of 80EE-B. He has purchased a electric vehicle for personal use. Since he has bought the electric vehicle for personal use, well, he's not claiming deduction under the head of business profession or under any other head of the income. Therefore, he'll be eligible for the entire amount. He'll be eligible under 80EE-B. Again, the loan is obtained for 11 months during the year. So 20 lakh rupees for 11 months at the rate of 10%, subject to a maximum. So cost of electric vehicle has got nothing to do with the deduction. Subject to a maximum of rupees 1,50,000. We have got a maximum amount of deduction that one could claim under this particular 80EE-B is 1,50,000. So although he has paid interest of 1,83,333, yet the maximum amount of deduction is restricted to 1,50,000. 20 lakh rupees into 10% into 11 months. So that is how we computed 1,83,333, which is restricted to 1,50,000. Let's check Mr. D. In case of Mr. D, he is taking loan from public sector bank. Again, it's an eligible institution. However, the loan is taken during the year 1819. Sorry, it is sanctioned during the year 1819. Now, this condition of 80EE-B is that the loan should be taken during the loan should be sanctioned during the financial year 1920. It could be taken at any time. It could be disbursed at any point in time. Disbursal happened in May 2019, but sanction happened in 1819, and therefore he doesn't become eligible to claim deduction under section 80EE-B. Right? No deduction would be available even though it is for purchase of electric vehicle for personal use. In case of Mr. D, the deduction is not permissible. The deduction would be nil. Let us move to the next set of deduction, and that is section 80G. So we have dealt with 80C, 80D, wherein 80C gave deduction in respect of instruments which were securing an individual or an HUF. Then we went on to medical health insurance and some medicine related set of deduction. Then we went ahead and claimed interest as deduction on certain items. So whether it is education or housing and an electric vehicle, now you now claim deduction for donations. Any donations given by an individual or any person, right? Either it could be individual, HUF, AOP, BOI, company, right? Any assessee or any person, there shall be deducted in accordance with and subject to the provisions of this section. You've got 4 kinds of deduction under this section. Now, this is one of the very, very complex provisions as far as the deduction is concerned. It is so clumsy, and it is designed in a manner which would confuse even the best of the readers of the act. However, let us try and simplify this. You have got 4 set of deductions, 4 set of donations which qualify for deduction, and the level of deduction is different in each of the case. See what happens, either you claim 100% deduction, or what you do is you claim the deduction available under 80G is broadly classified into 2 first. You claim entire amount of deduction, or you claim only 50% of the amount that you pay as donation. See, this is a deduction out of the gross total income of the assessee, and therefore gross total income is the driving factor here. Either you have a certain gross total income and you make a donation to one of the very, very eminent fund of the government, you claim a deduction of 100%. You don't make a deduction to an eminent fund of the government, but to certain other funds or certain other charitable trusts, you claim a deduction of 50%. So what they've done is they've categorized the donation according to the necessity of that particular amount of donation. Now 100% you could claim as deduction. Now here this 100% you've got further two subheads. So one, you could give a donation, claim 100% deduction without any qualifying amount. So there is no capping on the amount of donation that you give. So without any qualifying amount. Or you give a donation, claim 100% of a deduction, but within a specific range. Now what is that specific range? We'll come to it in a short while. So but then understand that there are four sets of deduction under this. One, you claim 100% deduction without any qualifying amount or with a qualifying amount. Similarly, you've got you give a donation, claim 50% of it as deductible without any qualifying amount, with a qualifying amount. So without any terms and condition, what is the donation that you give during the year, right, and claim 100% deduction? Well, if you look at the list, it is a long list of funds and trust wherein you could make a donation and claim 100% of deduction without any qualifying amount. And when you read it, you'll understand that it is more or less all of these funds are of national eminence. So very, very required funds, and the government wants to promote that you give donation to these funds. It would take care of the national interest and claim entire amount that you pay towards these funds without any qualifying amount. The National Defence Fund set up by central government, Prime Minister's Relief Fund, PM Relief Fund is one very widely used fund for the purposes of giving donation. Then Africa Public Contribution India Fund, National Children's Fund, you've got Fund for Communal Harmony, any Zila Saksharta Samiti or approved university of national eminence, state or national blood transfusion council. So when you look at the list, you could just go through the list once. You'll understand that these are all funds which are of national eminence, which are very much which add up to the nation, development of the nation. Just read it on screen. There are two recent additions to the list of 100% deduction. One is the Swachh Bharat Kosh, so which has been set up by the central government during this particular government, the regime of this particular government. Swachh Bharat Kosh set up by central government. Any amount that you pay as donation to the Swachh Bharat Kosh would be available as deduction under section 80G. Except for when the amount is spent for CSR activity. So companies are mandated by section 133(5) of the Companies Act to undergo CSR activity, the corporate social responsibility. It's basically the large companies which are mandated under the Companies Act to carry such activity. So if they are incurring any, they are giving away donation to the Swachh Bharat Kosh under the CSR activity, that is not available as deduction under 80G. You saw similar provision relating to CSR under section 37(1). While you dealt with section 37(1), you saw that any expenditure that you make for towards corporate social responsibility is not deductible, because the entire idea again is to let the companies who have got a net worth of 500 crores and above and turnover of 1000 crore and above, or the profits exceeding 5 crores and above, to contribute to the society. Now if they are contributing to the society, they are not taking benefit for tax purposes again. So that is why other than the amount spent by the assessee pursuant to CSR under section 135(5). But otherwise, if it is not a CSR activity, and any person who contributes to the Swachh Bharat Kosh would be entitled to a deduction of 100% without any limit. The Clean Ganga Fund, again similar to Swachh Bharat Kosh, it's the current government which has introduced this. Then you've got National Fund for Control of Drug Abuse. right? So here, all of these funds are basically funds of national eminence, wherein they contribute to the nation building, and therefore 100% deduction is available in respect of any such contribution to any of the funds listed. Well, the list is, it is always expanding. So you'll have a Corona Relief Fund, and even 100% deduction would be available there. But the point is, these funds are notified for the benefit of the nation. There are certain donations which qualify only for 50% of deduction without any qualifying limit. So we have seen 100% deduction without any qualifying limit. You've got now 50% deduction of the amount paid. So if the assessee is making a donation of rupees 1 lakh, what he could claim is, he could claim only 50,000 rupees as deduction, right, to these funds. So if he is making a donation of 1 lakh to Prime Minister's Relief Fund, he could claim 100% deduction. However, if he is making, deduction to Jawaharlal Nehru Memorial Fund, he could claim only 50% of the amount as deduction. So there are only 4 of these funds or trust, wherein you could make the contribution and claim 50% as deduction. So it is Jawaharlal Nehru Memorial Fund and the Prime Minister Drought Relief Fund, Indira Gandhi Memorial Trust, and Rajiv Gandhi Foundation. I would not wonder if the list goes down from 4 to 1 in a few days' time, right, or in a few years' time. Then deduction qualifying for 100% deduction, but subject to qualifying limit. Now here is there a limit. 100% deduction is available. You make up a donation of 1 lakh rupees and you claim 1 lakh rupees of deduction. However, this 1 lakh rupees of deduction is subject to a maximum limit. Now, what is that maximum limit? Well, in 2 cases, you see that there is a qualifying limit to deduction in respect of donation. This qualifying limit is 10% of the adjusted gross total income. So you're not to make, a donation exceeding 10% of your adjusted gross total income. What government wants is you don't give away everything that you earn as donation. Leave something for us. There should be something which the government should recover as taxes. And therefore, they say not more than 10% of your adjusted gross total income could you give as donation. So let's assume, the adjusted gross, what is the adjusted gross total income? We'll come to it in a short while. But then let's assume the adjusted gross total income is 1 lakh rupees of a person. What maximum he could give is 10,000 rupees of donation. So if he is giving more than 10,000 rupees of donation, that would not qualify for deduction. Now, if a person makes 10,000 of rupees of donation, he can claim entire amount as deduction. What if he makes 20,000 rupees of donation? What he can claim maximum is 10,000. Now, out of the 20,000, let's assume, he makes 8,000 towards those funds which qualify for 100% deduction, and remaining 12,000 towards those funds which qualify for 50% deduction. Now, in such a case, as an assessee, what you will do is first you will claim that donation which qualifies for 100% deduction. So you will consume the entire 8,000 out of the limit of 10,000 that you have got. So out of the 10,000, first and the foremost you deduct, you consume the 100% items of 100% deduction, and the remaining 2,000 rupees would go from those donations which qualify for 50% deduction. You'll see this by way of an example, but then understand that there is qualifying limit for certain donations made to certain funds, and that qualifying limit is 10% of the adjusted gross total income. Donation qualifying for 100% deduction, is donation paid to government or local authority or institution association for promoting family planning. So if you're making a payment of donation for any of the approved institution or local authority or government for the promotion of family planning, you can claim 100% deduction of such donation. Similarly, 100% deduction is also available in respect of donations made to Indian Olympic Association or any other sports association for development of infrastructure for sports or games, also or for the sponsorship of sports in India. So if you're making any such donation to an association or the Indian Olympic Association, that would again qualify for 100% deduction. In respect of 50% deduction, well, again, we've got a list of 5, wherein any institution or fund established in India for charitable purposes, which is approved under section 80G 5 of the Act. So if if you make a payment to an approved charitable institution, which is approved under 80G 5 by the commissioner exemption, in that case, you could claim 50% of the donation given by you as deduction under section 80G, and that is again subjected to the qualifying limit. Qualifying limit would be 10% of the adjusted gross total income. So this is the most used fund. Most of the assessee pay to charitable trusts and charitable organizations which are approved under section 80G 5. What they could claim is only 50% of deduction. So if you make a donation of 50,000 rupees, you could claim maximum 25,000 rupees, subject to 10% of your adjusted gross total income. The government or local authority for utilization for any charitable purpose other than, it says other than. The reason why it says other than promoting family planning, because family planning is already covered by 100% deduction. Thereafter, authority constituted in India by or under any other law satisfying the need for housing accommodation or for the purposes of planning, development, improvement of cities. So basically, those authority which are into giving away low-cost houses to poor, needy, or who are into development of cities. We've got a concept of smart city playing in. So if at all an authority which is into planning, development, improvement of cities, any donation made to such authority would be eligible for donation under section 80G, subject to 50% of the qualifying amount. Then, any corporation established by central government for promoting interest of the members of the minority community and for renovation or repair of notified temple, gurudwara, or place of worship, basically public worship of renown throughout the state. So these are a few of the items wherein you get 50% of deduction subject to qualifying limit. Now let's understand what is the 10% of the adjusted gross total income we were talking of. So adjusted gross total income here would mean 10% of gross total income that you have computed, adding all the foreheads and after the set off of losses and inclusion of income of any other person, whatever you've calculated as gross total income, out of that you got to deduct all of the other items of deduction under chapter 6A to arrive at adjusted gross total income. So your 10% of adjusted gross total income would mean your regular gross total income as reduced by deduction under chapter 6A except for section 80G. So barring 80G, all other deductions you claim, right? And that the remaining that you have got as gross total income, of that gross total income you got to find out 10% at the qualifying limit. So deduction would be eligible only to the extent of 10% of the qualifying limit in case of items covered by 3 and 4 above. What you got to do is, not only reduce the deductions, but also the short-term capital gain which is taxable under 111A, or the income which is subjected to special rate of taxes. Even that got to be reduced from the gross total income. Local long-term capital gain taxable under section 112 and 112A. So any long-term capital gain, basically, you have to reduce it from the gross total income. Any income on which income tax is not payable. So even the exempt income, if you have added it to the gross total income, that has to be reduced. Thereafter, whatever is the reduced gross total income, 10% of that would become your qualifying limit. The amount of donation that you have paid would be subjected to this qualifying limit. Let us understand this by way of an example. There are some more conditions, we'll come to it, but first let us understand this particular concept of adjusted gross total income by way of an example. Mr. Shiva, aged 58 years, so he is not a senior citizen, has gross total income of 7,75,000, comprising of income from salaries and house property. He makes the following payments and investment. He is making some of the payments. He's got income comprising of salary and house property. Premium paid to ensure the life of her major daughter. Right now, as far as major daughter is concerned, minor daughter is concerned, life insurance for children can be taken by parent without any condition. So 20,000 rupees is what he has paid towards life insurance. However, the capital sum assured is 1,80,000. Now the policy was taken after 1/4/2012, and therefore the maximum premium that he could have paid is 10%. What is eligible for deduction is only 10% of the assured value. So even though he has paid 20,000, yet what is available is 18,000. Had the daughter been disabled or suffering with any other diseases, in that case 15%, this 10% is increased to 15%. However, nothing of that sort is given. So what we do is we claim only 18,000 rupees out of the 20,000 rupees. Medical insurance premium for self 12,000, spouse 14,000. So the total premium paid by him is 26,000. He is aged 58, not a senior citizen, and therefore you'll have to restrict this to 25,000 under section 80D. Donation to public charitable institution registered under section 80G. Now this is public charitable institution which is approved under 80G 5, right? He makes a payment of 50,000 rupees by way of a check. This is eligible for 50% deduction, subject to 10% of the adjusted gross total income. We are coming to it. Therefore, now we are dealing with the adjusted gross total income, and what you could claim maximum is 50% of the amount which is paid by you. So LIC pension fund 60,000 rupees covered by 80CCC. Now all of this 80C, 80CCC, 80CCD, subsection 1 of 80CCD would be eligible, for a maximum deduction in aggregate of rupees 1,50,000. Thereafter, you've got donation to National Children Fund. Now, this is 100% without any qualifying limit. Then donation to Jawaharlal Nehru Memorial Fund, rupees 25,000 by way of check. So 50% without any qualifying limit. Donation by approved institution for promotion of family planning, rupees 40,000 by check. So he's given a lot of donation, right? 40,000 rupees, 100% of deduction subject to qualifying limit. There are two such items wherein you have got 100% deduction with qualifying limit. One of them is family planning, promotion of family planning, and the other is the Olympic Association contribution. Then deposit of PPF, again this is available as deduction under section 80C, subject to a maximum of rupees 1,50,000. So what we do here is, we find out the first and the foremost, we'll have to find out the adjusted gross total income of the person. So as far as the National Children Fund is concerned, when we talk of deduction under section 80G, National Children Fund is available, you can avail 100% deduction of any donation made without any qualifying limit. In case of Jawaharlal Nehru Memorial Fund, again you could claim 50% deduction without any qualifying limit. However, in case of approved institution for family planning, the donation is available to the extent of 100% only when it is subjected, only subject to the qualifying limit, that is 10% of the adjusted gross total income. For public charitable trust also, you've got the qualifying limit. So therefore, computing the qualifying limit becomes important here. let us see how we compute the qualifying limit. See, his basic gross total income is 7,75,000, out of which we first deduction under section 80C. So 80C would be, in respect of deposit in PPF, you have got 1 lakh rupees. Life insurance premium paid for daughter, I had explained you that it would be maximum 10% of the capital sum assured. Why? Because it has been taken after 1/4/2012. Right, so 18,000 rupees is available as deduction. There is something called as LIC pension fund, to which he is contributed 60,000 rupees, which is available under 80CCC. So the total deduction under 80CCC and 80C is 1,78,000. This is going to be restricted to 1,50,000 under section 80CCE of the Act. Thereafter, he also paid for medical premium to the extent of 26,000. What is available is 25,000. We did discuss this. So now what you are left with is the gross total income, right? The adjusted gross total income. You first have the gross total income simpliciter, out of which you deduct deductions under other sections of chapter 6A. So out of 775, you deduct 1,50,000 and 25,000. So when you deduct that, what is left here is, 6,25,000 minus 20. So 6 lakh rupees would be left. 6 lakh rupees is your adjusted gross total income. Your adjusted gross total income would be 6 lakh. 10% of it would be 60,000. Right? What you've got is a qualifying limit of 60,000 rupees. Now, what you would do first is, you utilize this qualifying limit of 60,000 towards that part of donation which is deductible to the extent of 100%. He has made contribution for an approved institution for family planning to the extent of 40,000. So out of the 60,000 rupees of the qualifying limit, 40,000 rupees would be entirely used towards this family planning expenditure, family planning donation that he has given. So what remains is only 20,000 rupees. And this 20,000 rupees, would be consumed for the donation given to another public charitable trust, which is approved under section 80G5. Right. So what we'll do here is, we'll let the 30,000 rupees of donation lapse. What we claim is only 20,000 rupees. However, this 20,000 rupees is claimable only to the extent of 50%. You don't get 100% deduction when you make a payment to a approved charitable trust under section 80G. So what you will get is only 50% of the eligible amount. So you claim 40,000 rupees for family promotion and 10,000 rupees towards this approved public charitable trust contribution of 50,000. Right. So that would make your entire donation come to 87,500. How the 87,500 is computed? Let us check it out. See, 25,000 rupees, 100% deduction towards National Children Fund. There is no qualifying limit. Jawaharlal Nehru Fund, 50%, no qualifying limit, 12,500. Since he contributed 25,000 rupees there, 50% of 25,000 would be 12,500. As per the approved family promotion expense, since we have got a limit of 60,000 rupees, qualifying limit of 60,000 rupees, and he paid 40,000 rupees towards the approved family planning institution, he can claim 100% of it, that is 40,000 rupees. And in respect of public charitable trust approved under 80G, he could claim only 50% deduction. But we have already consumed, out of the 60,000 qualifying limit, we have already consumed 40,000. And therefore, on the 20,000 rupees remaining, he could claim 50% of this 20,000, that is 10,000. All of this would add up to 87,500. So do you get this? As far as the donation is concerned, the adjusted gross total income, it would be important to compute the adjusted gross total income in the following manner, right? You take up the GTI simpliciter and thereafter deduct any other deduction that you've claimed under Chapter 6A, short-term capital gain, long-term capital gain, which are subjected to special rate. See, short-term capital gain only which is subjected to special rate got to be reduced, and not all short-term capital gain. So only that short-term capital gain which is covered by 111A in respect of shares and securities, right, subjected to STD. Only that got to be reduced out of the adjusted, while you compute the adjusted gross total income. Not everything. So there are a few more conditions, and the conditions are where a deduction under this section is claimed and allowed. When you claim a deduction under section 80G and it is allowed, you don't claim it under any other provision of the Act. So you're claiming it only under section 80G, and if it is allowed, you're not to claim it under any other provision. If it is not allowed, in that case, there would be an alternative ground that you could claim a deduction under section 37(1) for the donation that you make, provided you prove the business nexus. Anyways, as far as the donation under section 80G is concerned, you're not to pay a sum exceeding rupees 2,000 in cash, right? So you're not to make a payment of donation in cash exceeding 2,000 rupees. If you do make a donation exceeding rupees 2,000 rupees by way of cash, you're not to claim deduction under section 80G. Similarly, in-kind donations made to approved charitable trusts or any of the funds would not be eligible for deduction under section 80G. So what you got to pay is, you got to essentially pay sum of money if you were to claim deduction under section 80G, because who is going to value the in-kind donation that you give? It's very difficult. What is categorically clarified here is you should pay sum of money, only then you could claim deduction under section 80G. Nothing that you pay in kind would be available as deduction. So this is 80G. Let's move on to the next section, 80GG. Deduction in respect of rent paid. See what happens in case of salaried employee. Generally a salaried employee receives HRA and he could claim exemption under section 1013A of the Act. However, in case of mostly in case of self-employed person or business people, they also pay rent, but that rent is not available as deduction to them under the head of business profession, because it is personal expenditure. Provision have been made under section 80GG to allow for such rent that is paid by a person, an assessee being an individual who receives, who is not in receipt of HRA. So one who doesn't receive HRA, he can claim deduction in respect of rent paid by him for his residential accommodation. Right. So the essential condition is that to claim deduction under section 80GG is that the assessee should not be receiving any HRA, which is exempt under section 1013A. 2, he should incur the expenditure of rent. So rent should be actually be payable by the assessee. If he is not paying any rent, there is no question of a deduction under section 80GG. Not only he should pay the rent should exceed 10% of his total income arrived at after all deductions under Chapter 6A. So it says that you've got to pay rent in excess of 10% of the adjusted gross total income, right? So similar to the concept that we saw under section 80G, wherein what we dealt with was gross total income after reducing all the other deduction under Chapter 6A. Here also we have got 10% of gross total income after deduction of all other sections of Chapter 6A. Now what could happen here is, a person paying both donation under section 80G and rent under section 80GG, there could be a conflict, because 80G says you got to calculate gross total income after reducing all other deductions, and even 80GG says the same thing. In that case, you'll have to compute the 10% of adjusted gross total income by way of a simultaneous equation. So you'll have to solve a simultaneous equation. For the time being, understand expenditure incurred by him on rent of any furnished or unfurnished accommodation should exceed 10% of his total income arrived at after deduction under Chapter 6A except for 80GG. The accommodation should be occupied by the assessee for the purposes of own residence. So you should, he is paying rent for his own accommodation. The other condition is, the assessee or his spouse or his minor child or the HOF of the assessee should not own any accommodation at the place where he ordinarily resides. So you are taking a house on rent from your spouse or your HOF. That is not allowable. The assessee should not own his own house property and still take another house property on rent and claim deduction under 80GG. That is not allowed. What is allowed although is, he's got an accommodation at some other place. He has let it out because of his occupation. He comes to a new city or another city and takes an accommodation on rent there. So if he does that, 80GG would be allowed. If the assessee owns any accommodation at place other than the place referred above, that is his place of ordinary employment. So if he is owning that place other than the place where he is regularly employed, he can claim deduction under section 80GG provided the house that he owns is not claimed to be self-occupied. You don't claim it as self-occupied then. If you are claiming that particular house property as self-occupied and you are also paying rent, in that case you are not getting any deduction under section 80GG for sure, because you've already claimed one of the house property as self-occupied. A declaration is given by the assessee that yes, he fulfills all the conditions. The maximum permissible deduction under 80GG therefore is the actual rent paid by the assessee less 10% of the adjusted gross total income or 25% of the adjusted gross total income that we are talking of. Adjusted gross total income here would mean only the gross total income less any other deductions which have been claimed under chapter 6A. So 25% of such total income or amount calculated at rupees 5,000 per month. So maximum deduction under this particular section could never exceed 60,000 rupees. Although it is subjected to three conditions. The first condition being actual rent paid less 10% of the gross total income. If you recollect 1013A, you'll realize that it is quite similar to what the conditions are here in 80GG. So even under 1013A, you've got actual rent paid less 10% of salary, or 40 or 50% of salary. Here it is 10% of total income of the assessee because there is no salary income. Generally, it would be claimed by non-salaried people, or in case if it is claimed by salaried person, he is not in receipt of HRA. We're talking of 10% of total income instead of salary. And we're talking of 25% of total income, right? If you recollect HRA 1013A, it is 50% of salary or 40% of salary. So 50% and 40% limits have been provided in case of HRA. Here that limit is only 25% of the total income. However, here you've got a maximum limit of rent, and that is 5,000 rupees per month. The maximum deduction could be 5,000 rupees per month for the period during which the house property was rented by the assessee. It is not 5,000 into 12. It is for the span of time when he has actually rented a property. So this is 80GG, and next let's move to 80GGA. Deduction in respect of donation for scientific research and rural development. So similar to what you read in the under the head of PGBP section 35 AC. Similar to that, for those who are not claiming deduction, who couldn't claim deduction under the head of profits and gains of business or profession, would claim it again here under chapter 6A under section 80GGA. Any assessee not having income chargeable under the head profits and gains of business profession who makes donation for scientific research or rural development, right? So he shouldn't have income under the head of PGBP. The idea is simple, if you've got income over here, you'll claim it under section 35 or 35 AC or the series of those section. If you're not having any business profession, only then would you come to 80GGA. Here the deduction is 100% of the amount contributed. As far as business profession is concerned, you get some weighted deduction in respect of a few of those expenditure. But here it is flat rate of 100%. The amount that you incur, and it is available to any assessee. It is not necessary that the assessee should be only an individual or HUF. It is available, 80GGA is available to any assessee. Well, what qualifies for deduction? Any sum paid to a research association. So you're making payment for research or scientific research association, to college, university approved under section 35(1)(2). So very, very similar to what you have already dealt with under the head of PGBP. Then so any sum paid to research association for social sciences or statistical research, even social sciences and statistical research is covered, provided it is approved under 35(1)(3). Then any sum paid by the assessee in the previous year to an association institution carrying on program for rural development. So if you are making a payment for rural development, even that would be covered. It should be approved under section 35(CCA). So when you are making such payments to an approved institution for rural development, for scientific research, or social research, right, or to a public sector company which is engaged in a project which is approved by the national committee, right, or National Urban Poverty Eradication Fund, all of such donations or contributions, here it would be more of contribution. Donations are covered by 80G. Here you're contributing for scientific research, you're contributing for social research or rural development, a fund set up for rural development. In that case, you'll get a deduction of 100% without any restriction. The only condition is that you should not have income under the head of PGBP. If you've got income under the head of PGBP, you will have to claim deduction under those respective section under the head of PGBP. Well, no deduction shall be allowed in respect of donation of sum exceeding rupees 10,000 unless such sum is paid by any mode other than cash. So here you have got a limit of 10,000 rupees which you could make a payment in cash. In case of 80G, the limit is only 2,000 rupees. So 2,000 rupees of donation under section 80G could be made in cash. Anything exceeding 2,000 rupees cannot be made in cash. However, under section 80GGA, it is 10,000. So the limit doesn't seem to have been changed for some reason. Probably they forgot. Then, deduction in respect of contribution given by companies to political parties again. Now, political parties do need funds, and big corporates, Indian companies, they would provide funds to such political parties. Whatever contribution is made by an Indian company to any political party or an electoral trust. So either you make a payment to an electoral trust or a political party, and if the assessee is an Indian company, so only an Indian company can claim deduction in respect of contribution made by it to a political party or electoral trust, provided no such contribution should be made by way of cash. So everything should be made through banking channel or through the specified modes, not by cash. The essential condition is Indian company should not make any contribution to an electoral trust or a political party by way of cash. If you're making a contribution by cash, nothing would be allowed as deduction under section 80GGB. What is contribution? So contribution would mean either you make a donation, you make a subscription or payment given by a company to person for carrying on any activity which is likely to affect public support of a political party. So it is not a direct it may not be a direct contribution to the political party itself. It could be a contribution to a political person who is likely to have an effect over the public support of the political party. Similarly, expenditure by way of advertisement in any publication in a political party, souvenir or brochure or pamphlet, even that would be covered over here under section 80 double GB. Political party would mean a party registered under the Representation of Peoples Act 1951. Similar to the contributions that are made by Indian company to a political party, that is allowed as deduction to the extent of 100% of such contribution. Any other person who makes, a contribution to a political party, even that is allowed as deduction under section 80 GGC. Under section 80 GGC, any person other than company can claim deduction when it makes a contribution to political party or an electoral trust. However, no such deduction shall be allowed in respect of contributions made by cash. This deduction is, however, not available in respect of local authority or AJP wholly funded by government. So, government making donations via a local authority to a political party, no, that is not allowed. And even otherwise, if such payment has happened, no deduction would be available under section 80 GGC. Right? Political party would have the same meaning again. Alright, let's take a break of 5 minutes and we come back again to understand 80 double J double A. which provides for deduction in respect of new employment generated by the employer. So when there is an employment generation by any of the employers, he can claim deduction in respect of the outlay for such new employment that he has generated under section 80JJAA. Now this is in addition to the deduction that he claims out of the business income. What he gets is 30% of additional employee cost as deduction under section 80JJAA. Now what is this additional employee cost? That is something we will have to find out. Who could claim the deduction? Whether gross total income of an assessee to whom section 44AB applies. Now section 44AB would apply to an individual who has got a turnover of more than 2 crore rupees, right, or 1 crore rupees as the case may be. If he's not covered by 44AD, he would be eligible for an audit under section 44AB if his turnover exceeds 2 crore rupees. Generally, for all other assessees, the limit is 1 crore. Include any profits and gains derived from business. So it is only applicable to an assessee who derives income from business and not from profession. So all of those assessees who are engaged in business and who are able to create new employment would get an amount equal to deduction of an amount equal to 30% of the additional employee cost incurred in the course of the business in the previous year. And not only for the year in which the additional employment is generated, it is the next 3 assessment years including the assessment year relevant to the previous year in which such employment is provided. So you can claim deduction for 3 years, right, for the new employment that you have generated and the additional cost that you have to incur because of the new employment generation. This is basically promoting employers to create new jobs. Once they create new jobs, they make a outlay towards salary. Whatever emoluments they pay to the employees, 30% of such additional employee cost would be available as an additional deduction under section 80JJAA. There is no maximum capping on this deduction under section 80JJAA. However, what you'll have to do is you'll have to see to it that the increase in the cost of employee is real. So it is not like, there is no new fresh employees coming in, just the cost is growing, cost of salary is growing and you claim an additional deduction of 30%. That is not allowable. Let's check out the condition therefore. The deduction would be allowable only subject to the fulfillment of the following conditions. The business should not be formed by splitting up or reconstruction of an existing business. So you not to just split up the existing business and into the new business claim that I have generated new employment. That is not the intention. The intention is to create real employment opportunities. The business is not acquired by assessee by way of transfer from any other person as a result of business reorganization. So again, similar to splitting and reconstruction, what could happen is there could be a transfer of business and you would claim that you have started a new business and therefore you have generated new employment. That is again not the intention. You should start a new business altogether, generate employment, whatever employment you generate, 30% of the additional employee cost would be available as deduction under 80JJAA. Provided you give a report of a chartered accountant who would certify that yes, indeed you have generated new employment and you have incurred X amount as an additional employee cost. Understanding what employee cost would mean is important. The total emoluments paid or payable to additional employees employed during the previous year. Now, additional employees could be employed both in new business. An assessee who sets up a new business entirely, he would incur some additional employee cost, right? Or in case of an existing business. As far as the existing business is concerned, the section categorically says that additional employee cost shall be nil. So you're not to consider additional employee cost if there is no increase in the number of employees. So this is what I was talking of. There should be real growth in the number of employees. If there is no growth in the employees and there is, you are expending only the salary and the salary cost has increased, no deduction would be available under 80JJAA. There should be an increase in the number of employees from the total number employed on the last day of the preceding year. So the closing number of employees of the preceding year and the closing number of employees of the current year, there should be a change in that number of employees, and it should be a positive change. If at all there is a decline in the number, the additional employee cost would be treated as nil. Only if there is an increase in number of the employees vis-a-vis the previous year, immediately preceding year, only then could you claim the deduction under 80JJAA. Further, in case of existing business, and another condition is emoluments are paid otherwise than by an account pay check or account pay bank draft or the specified electronic modes. We are making payment in cash, again that is not allowed. However, in case of new businesses which have been set up by a person and he employs some people, all emoluments paid by such new businesses would be available as deduction under section 80JJAA, subject to 30% of the additional employee cost. What is additional employee? Now, how you could see they've plugged a few loopholes wherein additional employees could be planned. You take some employees on the last day of the year, right, and then you claim that these are my additional employees. So they say that no, you have to employ a particular person at least for 240 days during the year. So employee who has been employed during the previous year and whose employment has an effect on increasing the total number of employees would amount to additional employee. However, what is excluded? Number one, employees whose total emoluments are more than 25,000 rupees per month. So high paid employees, they are to be excluded. Number two, those who do not participate in recognized provident fund. So employees who are kept out of the employees provident fund scheme, they are to be excluded. Employees employed for a period of less than 240 days. So if an employee is employed on the last day of the financial year, there would be an increase. But if he is employed for less than 240 days, he should be excluded. Fair enough, because otherwise what people would do, people would plan the number of employees that have increased. Number of employees would really increase only if the particular employee is there in the organization for at least 240 days during the previous year. Now what could happen? You employ somebody during part of the year. You employ, let's assume you employ somebody in the month of March 20. Now he is not employed for 240 days during the current year, and therefore you'll have to exclude his salary out of the the additional cost of the employee. However, what happens is during the year 2021, that is in the subsequent year, he might stay for more than 240 days. Let's assume he is employed for the entire year. You couldn't claim deduction during 1920 because he was employed for less than 240 days. In 2021, I would say that he is not a new employee. He was already employed in the preceding year. Now, if I say that I lose the benefit of the additional cost that I've incurred for this new employee, and therefore provision have been made wherein they say that even if in the next succeeding year, immediately next succeeding year, if an employee is employed for 240 days, the next succeeding year, you could treat him as a new employee in the next succeeding year, not in the current year in which he is employed, but he would be treated as an additional employee in the next succeeding year, that is in the year in which he is employed for 240 days. So any employee with the total emoluments of more than 25,000 rupees per month, one who does not participate in recognized provident fund, one who is employed for less than 240 days would not form part of the additional employees, right? So additional employee would mean those employees who are paid paid a salary of lesser than 25,000 rupees per month. Those who are those who are part of the recognized provident fund of the employer and employed for 240 days. However, in case of apparel, footwear and leather product industry which is engaged in manufacturing business of apparel, footwear and leather, would have an employee who's worked for less than 150 days, he would only be excluded. If an employee is worked for more than 150 days in apparel, footwear or leather product industry, he would be treated as an additional employee. So the timeline of 240 days is reduced to 150 days. So as far as the succeeding year is concerned, I've already explained you what could happen. An employee is employed for a shorter span of time in the current year, but he could be employed for 240 days or 150 days as the case may be in the succeeding year. In that year, he would be treated as an additional employee. Then what is emoluments? So emoluments would mean anything that you pay to the employee in lieu of the employment by whatever name called. So all the employee costs would be included, excluding, the exclusions are contribution of the employer to a pension fund, contribution of the employer to a provident fund, right? So these fund contribution which the employer makes on for the benefit of the employee, that would be excluded. Any lump sum payment made to the employee on voluntary retirement or superannuation, even that cost would be excluded. Understand, the additional employee cost is available, 30% of the additional employee cost is available for 3 years, right? Including the year in which the additional cost was incurred for the first time. So it is 3 years. It might so happen that an employee is employed in year 1, year 2, and he retires in year 3. So his cost would include the cost of voluntary retirement or the retrenchment compensation. Now that is not to be paid for. You don't pay for. You don't give a deduction of 30% for such retirement benefits or retrenchment benefits which an employee would get, even if he is an additional employee. Similarly, for those employees who, let's assume, there would be only one employee who is increased and you pay him 1 crore rupees. Now 1 crore rupees would mean 30 lakh rupees of a deduction, but then specifically kept out of 80JJA. They say that employees who earn more than 25,000 rupees are not to be calculated as additional employee under section 80JJA, because otherwise what would happen, there would be only one increase in the employee and you straight away get a deduction of 30 lakhs, 30% of 1 crore, right? Increase in the cost of the new employee. So that is not the intent. The intent is, to generate more and more of employment in the mid segment, wherein an employee is getting lesser than 25,000. Let's take up a problem and understand this. A has commenced business, so it's a new business. In case of new business, any employment given in the first year would be additional employment, right? And he would be subjected to, you will have to verify whether the employee was there for 240 days, whether his salary was above 25,000 or below 25,000, and give right away the deduction at the rate of 30% of the additional cost. Mr. A commenced the business of manufacture of computers on 1/4/2019. He employed 350 new employees, right? So 350 new employees were employed by Mr. A in his business of manufacturing of computers. Now this is not, he's manufacturer of computers, not that of leather or apparel, right? So he's not a manufacturer of leather, apparel or the footwear, right? So footwear, leather and apparel, the days are reduced to 150 days. We'll have to stick to 240 days therefore. So again, the business is given to you. So you understand that 240 days employee would only qualify for being treated as additional employee. 350 new employees during previous year 1920, the details of whom are as follows. Number of employees 75, 125, 50 and 100, adding up to 350 employees. Date of employee at the beginning of the year, what he has done, he has employed 75 employees. Regular, they are classified as regular, and the total emoluments paid per employee was 24,000. That is lesser than 25,000. Since it is less than 25,000, they all qualified to be classified as additional employees. Thereafter, 125 employees on 1/5/2019 again classified as regular, but the total emoluments exceed 25,000. Since they exceed 25,000, nothing is allowable as deduction. As far as the next 50 employees that he has employed, they are casual employees. Again, the total emoluments paid is 25,500, greater than 25,000, and therefore no deduction would be allowable under JJAA, 80JJAA, right? We are not concerned with whether it is greater than 240 days or whether it is less than 240 days for the time being, because the total amount of emolument exceeds 25,000 rupees. Thereafter, 100 new employees were employed on 1st of September 2019. Again classified as regular. These employees are paid for 24,000, which is lesser than 25,000. So they might be eligible, but we got to find out whether these 100 employees were employed for 240 days during the year. So we get to know, during the year they were employed for only 180 days, right? Or 180 odd days. Some odd days and not 240 days. Since they were employed for lesser than 240 days, they do not become eligible during the current year. However, they would become eligible in the subsequent year, right? They could. The regular employees participate in recognized provident fund. They say that the regular employees participate in recognized provident fund, while the casual employees do not. So casual employees, they do not satisfy an additional condition, that is, they're not part of the employees provident fund. If they're not part of the employees provident fund, even had this been lesser than 25,000, let's assume it is 20,000, yet these casual employees would not have been qualified as additional employees. Compute the deduction, if any, available to Mr. A for AY 2021 if the profits derived from manufacturing of computers that year is 75 lakhs and his total turnover is 2.16 crore. Now, why this turnover is given? Because he is covered by section 44 AB. Only if he is covered by section 44 AB would you classify him as, would he become eligible for 80JJAA. The number of additional employees, total employees 3,50,000, out of which casual employees are not eligible because they are not participating in recognized provident fund, and also you pay them more than 25,000. Thereafter, those employees who are getting 26,000 rupees, even though they are employed during the year, yet since their emolument is 26,000 rupees greater than 25,000, they are also ineligible. So we deduct the additional employees employed during the year with this employees who are getting more than 25,000 rupees of salary, and regular employees who are not employed for 240 days. So since they have been employed for roughly, approximately 180 days, lesser than 240 days, I would deduct even the last leg of the employees employed on 1st of September 2019. They might become eligible in the subsequent year, that is 21-22. For the assessment year 21-22, you could claim deduction for these set of employees who are employed for lesser than 240 days in the current year. So total number of additional employees is only 75, which is nothing but the first set of employees employed on 1/4/2019. So only these employees are qualified under section 80 JJAA. Now what is the amount of deduction therefore? They are employed for the complete year, right? So 24,000 rupees of salary into 75 employees into 12 months. So that would become your total additional cost. Now out of the total additional cost, what you end up paying is only 30% of such cost. So only 30% would be eligible under 80 JJAA. So you are going to claim only 30% of it under 80 JJAA. You could claim the employee cost under the head of business profession. In addition to that, you get this 30% subject to a CA certificate. Additional cost 24,000 into 12 into 75, that is 2 crore 16 lakh rupees of additional cost, and 30% of that would be 64 lakh 80,000. Now assuming that Mr. A is not a computer manufacturer, but is engaged in either the apparel industry or the leather manufacturing industry, in that case what could happen is, in that case this limit of 240 days would be reduced to 150 days, and therefore the last leg of employees which have been employed on 1st of September 2019, they would also become eligible for 80 JJAA. Had the information been that Mr. A is into the manufacturing of leather or apparel or the specified business there, and the limit would be 150 days in respect of employees. Now here these 100 employees would be employed for more than 150 days, and therefore what we do is we'll add these 100 employees into rupees 24,000 into 9 months, 6 months, 6 or 7, 7, sorry. Yes, 7 months. They were employed on 1st of September. So September to March, including September, would be 7 months. So since they are employed for more than 150 days, that is more than 5 months roughly, they would be eligible, that these employee cost would also be eligible for 80 JJAA. Right? So you add 64 lakh 80,000 with 30% of 100 employees into 24,000 into 7 months. That would be your eligible deduction. I hope you get this. Any questions? So businessman removes 39 employees and put 34 employees, considering all conditions are fulfilled. Then see, removing an employee is not a problem here. The total number of employees the employee should work for at least 240 days. If they are not working for 240 days, the additional cost would not be eligible for deduction under 80 JJAA. So let's move on to the next set of deduction, that is 80 QQB. Deduction in respect of royalty income. So eligible assessee and quantum of deduction is 3 lakh rupees of deduction. Maximum 3 lakh rupees of deduction is available under 80 QQA to an individual resident in India. See, the deduction is in respect of royalty income earned by authors of certain books, right? And therefore the deduction is available only to individuals, because authors could be individuals. The maximum amount is 3 lakh rupees or the royalty income actually received. Right? If the royalty income is less, let's say 1,50,000 rupees, you could claim deduction only to the extent of amount received and not 3 lakh rupees. But however, if the royalty income is 5 lakh rupees, the maximum deduction would be 3 lakh rupees. Now eligible income would be income which is received by way of a lump sum consideration. So you sell the rights in the book and you get a lump sum amount. Whatever lump sum amount you get would be eligible for deduction under 80 QQB, provided you're not taking deduction under any other head of income. If you're taking deduction for such royalty income under any other head of income, in that case 80 QQB is not available. Also, not all books are covered. It is only the book which are in the arena of literary work or artistic or scientific nature, right? Only those books would be covered. So textbooks probably, or the school guides, commentaries, newspapers, they're not covered. Even though royalty is paid for them, they are not eligible for deduction under 80QQB. So such books should be work of literary, artistic or scientific nature, or of royalties or copyright fees, whether received in lump sum or otherwise in respect of such books. You receive a lump sum amount or a share. So what happens is, either the publication house would give a lump sum amount to the writer, or it could share the revenues. Royalty is sometimes given by way of, as a percentage of the value of books sold. So when it is given by way of a percentage, it says, the Act says that the income shall not exceed 15% of the value of books sold during the previous year. So the total royalty, if it exceeds 15% of the value of books sold, in that case, no deduction would be, deduction would be restricted to 15% of the value. So if a particular author is getting 20% of value of books sold, he would be eligible only for 15% of royalty that he gets, and that too would be subjected to a maximum of 3 lakh rupees. Not more than 3 lakh rupees could he claim as deduction under 80QQB. Then for claiming the deduction, assessee shall have to furnish a certificate in the prescribed manner duly verified from person responsible for making payment of such royalty. So you will have to take a certificate from the publication house that they have indeed paid royalty to the author of book. The book would be either the literary work or the scientific work. Only then could you claim deduction under QQB. It could happen, that royalty is earned from a publication house outside India. When the source of income is outside India, you'll have to bring that income into convertible foreign exchange within 6 months from the end of the year in which it is earned. Only if you repatriate the funds from outside India, repatriation is important, and repatriation should be done within 6 months. If at all you have repatriated the amount of royalty that you have earned outside India, only then could you claim deduction under 80QQB. If you don't do that, nothing would be available as deduction. When an assessee claims deduction under this section, no deduction in respect of same income can be claimed under any other provisions of the Act. Right? So you are claiming either deduction under 80QQB, or you are claiming expenditure under other provisions of the Act out of the royalty income. It depends on if you have incurred more expenditure than 3 lakh rupees and it is directly relatable to earning of the royalty income, probably should go for other section of the Act rather than 80QQB. Similar to royalty for books, in case of authors, there is royalty received on patents. In case of invention made by individuals, right, they receive royalty for use of patents by manufacturing units, or by any other person who's using that invention for their commercial purposes. A resident individual, so who's covered? A resident individual is covered who is resident as true and first inventor. So he should be true and first inventor in respect of invention under the Patents Act. So if it is Patent Act and an individual is the first true and first inventor, he has got a registered patent. The patent could be either for the process or for some article, right? It could be any patent in respect of registered under the Patent Act 1970, and the individual is the first inventor of such patent. If he gets any amount of royalty for use of such patent, he could either transfer it entirely, or he could just let other person use the patent. If he is receiving any royalty for such use or transfer of the patent as lump sum amount, or by any other mode, by any other percentage, so that would be deductible under section 80RRB subject to a maximum of 3 lakhs. So like the royalty that you received in case of author, which was subject to a maximum of rupees 3 lakhs, here also you have got a limit of 3 lakhs every year. Similarly, here also you have got a specific condition that no deduction in respect of such income will be allowed under any other provision of the Act. The eligible income would be restricted to rupees 3 lakh. The eligible deduction would be restricted to rupees 3 lakh, and the income would be in respect of transfer of right in patent or use of patent. So either you're transferring the entire right of the patent, you're selling it off, or you're providing the use of the patent or some information as to how to use a particular patented process. So if you're doing that, and any amount you receive would be eligible for deduction. But then what is not eligible? The exemption shall not be available for any consideration for sale of product manufactured using the patented process or patented article. See, whatever you derive out of the use of the patent or the transfer of the patent itself would only be eligible for deduction here. If you are claiming revenue from sale of a product that has been produced using the patented process, that would not be eligible for deduction here. Understand this very carefully. You are using a patent, and for the use of patent, you get some amount. The patent belongs to you, and what you do is you let somebody else use it and you get a fixed amount. That is eligible for deduction. But if at all, by using the patent, if manufacturing activity is done or a product is produced and that product is sold, if the product is sold thereafter, any consideration receiving out of the sale of a patented product would not be eligible for deduction. Only the patent itself is a product here. Any product that is manufactured because of the patent, that is not covered under this particular section 80 RRB. Condition. So, same condition here, that if you are getting any royalty from outside India, you'll have to repatriate that royalty in India within 6 months from the end of the previous year in which it is earned. Only in case if you repatriate it, would you be eligible for deduction of rupees, maximum deduction of rupees 3 lakhs. Next, deduction in respect of interest on deposit in saving account. Eligible assessee and quantum of deduction. Section 80 TTA provides that in case of gross total income of an assessee being individual and HUF, this set of deduction is available only to an individual and HUF, and who is earning interest on deposit in a saving bank account, right? So only if there is an income in the nature of interest on saving bank account, that would be eligible for deduction under section 80 TTA. The maximum amount of deduction would be 10,000. See, it is only the saving deposit account and not any other deposit account. So if an individual or HUF is earning interest on time deposit, now that is not eligible for deduction here. What is eligible for deduction under this section is only the interest on saving deposit. So all saving bank account taken together, right? So a person might earn, interest on saving account in bank X of rupees 3,000, in bank Y of rupees 7,000, in bank Z of rupees 15,000. The total amount of deduction would be maximum 10,000. Such deduction is allowed in case of saving account maintained with a banking company or a cooperative bank, right, or a post office. So post office saving account, banking company, or a cooperative society. Now post office saving account is also eligible for deduction under section 1015I. We've dealt with this 3,500 rupees of deduction. Deduction under this section would however not be available to a resident senior citizen. Why a resident senior citizen is kept out of it? Because they are eligible for deduction under section 80TTB. A separate set of deduction was introduced from AY 1920 in case of senior citizens under section 80TTB, and there, a wide range of interest is covered. So it is not just the saving bank account, but it covers also the time deposits. We'll come to 80TTB. For the time being here, this deduction is available to individuals and HUF on interest received from saving account up to rupees 10,000. Deduction up to rupees 10,000. Maximum deduction, remember, 10,000. If the aforesaid income is derived from any deposit in saving account held by or on behalf of the firm, an AOP or BOI. So what happens is, AOP or BOI is earning interest on the deposit. It shares the income with the members of the AOP or BOI. Now, if AOP or BOI is claiming deduction under this section 80TTA, no further deduction would be available to the individuals. So fair enough, double deduction of the same item would not be available. Then let's move to 80TTB, deduction in respect of interest on deposit in case of senior citizens. So senior citizen who is of the age of 60 years or more at any time during the relevant previous year. So he's a resident individual. So a non-resident senior citizen is not covered here, right? Only a resident individual who has attained 60 years of or more of age during the current previous year would be included, whose gross total income includes income by way of interest on deposit. So any deposit for that matter received from a banking company, cooperative society or a post office, similar to what we have seen in 80TTA. The quantum of deduction, however, is increased from 10,000 to 50,000 over a year. Amount of interest on deposit would be 50,000. Would be restricted to 50,000. So interest actually received. Let's assume a senior citizen has received 30,000 rupees of interest on time deposit. He could claim deduction of entire 30,000. But if this is 80,000 rupees, the restriction is 50,000. Not more than 50,000 rupees of deduction. Non-availability of deduction to partners, members where deposit held by firm AOP or BOI. So, well, that is, understandable. If the firm is holding a deposit and paying profits to the partner cannot claim deduction out of those profits. Anyway, the profit is exempt from tax, but then double deduction isn't possible. So, a member of AOP or BOI receiving interest from the AOP or BOI who has already claimed deduction under 80TTB, right? No further deduction would be available. Although, it is fairly understandable. There is no question about a double deduction. AOP or BOI couldn't be a senior citizen anyways. And any income received from AOP or BOI is not in the nature of interest from bank. Thereafter, deduction in respect of a person with disability. We've discussed 80DD. Now this is similar to 80DD. However, under 80DD, it was a disabled dependent. A person who was dependent, assessee could claim deduction under section 80DD for a person who was dependent on the assessee to the extent of 75,000 rupees or 1,25,000 rupees in case of severe disability. Now, if a person is disabled but he's not dependent on anybody, he could claim deduction independently under section 80U of the Act. Right? 80U harmonizes the criteria for defining disability as existing under the income tax rules. Right? The eligible assessee is a resident individual, so only resident and individuals are covered. Right? Who at a time during the previous year is certified by medical authority, the civil surgeon, to be person with disability. The benefit of deduction under this section is also available to person who are suffering from autism, cerebral palsy or multiple disability. Deduction is to the extent of 75,000 rupees in case of assessee who do not have severe disability. In case of assessee who is having severe disability, this deduction of 75,000 rupees is increased to 1,25,000 rupees. Now the conditions are that assessee claiming a deduction under this section shall furnish a copy of certificate issued by medical authority. So you have to furnish a copy of certificate. Now that the income tax returns are to be filed through electronic mode and not manually, such certificate cannot be produced along with the income tax return. You cannot send any other data or any other information through the income tax return because it is all transmitted electronically. So harmoniously constructing, you'll have to produce it before the assessing officer whenever it is required by the assessing officer. You should have the certificate of civil surgeon to claim deduction under this particular section 80U. In case if disability is such that it requires reassessment every year, what could happen? There is some disability and that you're undergoing rehabilitation. The assessee the status of the assessee could improve, and if at all there is an improvement in disability or the disability goes away completely, in that case the deduction should stop, and therefore where the disability requires reassessment, a fresh certificate shall be obtained through a medical authority after the expiry of period mentioned on the original certificate. So sometimes the civil surgeon would say that a certificate of disability would be given for every 3 years. So after every 3 years, you'll have to obtain a new certificate. Some of the diseases are such that they leave a permanent disability, either disease or there is amputation, etc. You become the assessee could become permanently disabled. Now, if he becomes permanently disabled, there is no question of obtaining certificate at a regular interval, right? This certificate would be required only in case of disability which have the scope for improvement. So this is 80U, similar to the 80DD section that we saw. The deduction is 75,000 in case of non-severe disability and 1,25,000 in case of person who is severely disabled. Now this is assessee himself. If it is dependent, you have to go to 80DD. Both the section makes the circle complete. Let's take some problems. All right. I have a question. Disabled recovered in the middle of the previous year. No, it is for us. Komal is asking whether a disabled who is recovered in the middle of the year, can he claim 50% deduction? The answer is no. Understand, either he would be a disabled during the year or he would not be. If he is not, if the certificate is revoked, he cannot claim partial deduction under section 80U. During the financial year 1920, Mr. Amit paid interest on loan availed by him for his son's higher education. Right now, loan is taken for higher education subjected to section 80E. His son is already employed in a firm. Mr. Amit will get deduction under section 80E. Whether the statement is correct, whether a dependent son, loan taken for a independent son, he is already employed, for higher education, whether that would be eligible for deduction under section 80E of the Act. Yes, answer. Well, yes, he would be indeed eligible for deduction under 80E in respect of interest paid on loan for higher education of himself or any of his relative. Now, since in case of Mr. Amit, he has borrowed the loan for his son. No, even if the son is not dependent on him, he could still claim the deduction under section 80E. However, if the son decides to claim it in his own return of income, in that case, Mr. Amit would not be able to claim it. But then since Mr. Amit has paid it, he could claim the deduction under section 80E. It is immaterial whether the son is already employed or he may not be. Then, next is subscription to notified bonds of NABARD. Would it qualify for deduction under section 80C? Yes, the deduction in respect of NABARD bonds which are approved under section 80C, the Bank for National Bank for Agricultural Development, right? Whatever you pay, whatever you subscribe to the bonds of NABARD, that is available would qualify for deduction under section 80C. Provided no other deduction under any other section of the Act is provided for such bonds. Then, in order to be eligible to claim deduction under section 80C, investment, contribution, subscription, etc. in eligible or approved mode should be made out of income chargeable to tax. Now, whether there is a condition that you should make, investment only out of income chargeable to tax, the investment could be made out of any income. The deduction would be allowed only out of income chargeable to tax. So there is no such there is no such condition or stipulation that income should be chargeable to tax and the investment should be made only out of the income chargeable to tax. No, the deduction would only be available out of income chargeable to tax. Investment could be made out of any of the funds. Then, where any individual repays a sum of rupees 30,000 towards principal and 14,000 as interest in respect of loan taken for pursuing higher education, the deduction allowable under section 80E is 44,000. Now, whether deduction under 80E would be 44,000, that is principal plus interest, or whether it would only be interest, whether it is only interest on education loan. Can the individual claim entire 44,000 rupees as deduction? The answer is no, certainly not. What is available as deduction under 80E is only the amount of interest on such housing loan, on the education loan, and not the principal amount. Principal amount is not deductible under section 80E. Only the interest amount incurred by the person would be eligible for deduction. And that too for a span of 8 years, including the year in which he first starts paying the amount of interest. Then, Mrs. Sheila, widow of Mr. Satish, who was employed with XYZ Limited, a private employer, receives 7 lakh rupees on 1/5/2019, being amount standing to the credit of Mr. Satish in his NPS account. Now, what is received by Sheila is in capacity of a legal heir. Whatever is received by a legal heir from a national pension scheme out of the closure of the NPS account would not be taxable under 80CCD, right? Or would not become taxable at all. In case if Mr. Satish was alive and he would have withdrawn it in that case, it would be subjected to section 1012A. We saw it yesterday that up to 60% would be exempted. Rest of it would become taxable. However, in case of uh, the legal hair, the condition was very clear that the legal hair on closure receiving any proceed would not be taxable at all. Such amount received by her as nominee on closure of the account would not be deemed as her income. Thereafter, Mr. Vishal, a central government employee, contributed rupees 50,000 towards Tier 2 account of NPS. The same would be eligible for deduction under Section 80 CCD. Whether an employee, whether a central government employee, for his contribution to the tier 2 account, whether it would be available as deduction. See, there are two types of account, tier 1 account and tier 2 account. As far as the tier 1 account is concerned, it covers section 80 CCD 1B. The additional deduction of 50,000 rupees under 80 CCD 1B is available only if such contribution is made by the employee to the tier 1 account and not to the tier 2 account. Let's check. Tier 2 would anyways qualify for deduction under section 80C. 80C is available for a government employee. The last clause that we saw under section 80C was in respect of government employee, and government employee can claim it under 80C and not 80CCD. Alright, I'll check up some doubts and then we close for the day. Kristen says, suppose to take this advantage, Mr. X removes all employee at the end of the year and recruit again on 1st April once again. Whether the deduction would be available. Well, once an employee becomes part of the provident fund, therefore the condition relating to provident fund was made mandatory so that there is a structure to that deduction. If a person is becoming part of the provident fund, you cannot just remove the employee just like that. There is a process to it. It is not that simple, to go in for a retrenchment of an employee and again re-employ the same employee. It won't fit the entire structure. Nothing of that sort is possible. So, Christian, it's not simple to retrench and do a planning like this. You remove all the employees on the last day and re-employ them on the next day. Not possible. Then. Komal is asking if a businessman removed 39 employees and put 34 employees, considering all conditions are fulfilled. Yes, if at all, there are some of the employees which have been removed in the preceding year, and because of that, your total number of employees as on the last day was something less than the subsequent year. If there is indeed an increase, you could very well claim deduction under 80JJAA. His contribution to PM CARES fund is eligible for deduction under 80G. You're right, Mansha. Eligible assessee for claiming deduction under Section 80DDB should be resident in India. Does this resident include RNOR? Yes, Mancha, it does include RNOR. A resident is a resident, whether he is ordinarily resident or not ordinarily resident. Doesn't matter. Komal is asking if deduction under 80EE loan should be taken in previous year 16-17. How can a person be eligible for both 80EE and 80EE? Well, a person cannot be eligible for under both section 80EE and 80EE for the same amount of loan. 80EE covers only loans which are sanctioned during the previous year 16-17. 80EE covers loans which are sanctioned post 16-17, that is in the year 19-20. So it has to be two sets of loans. But then, assessee should not be owner of a house as on the date of sanction. If he owns any house as on the date of sanction, he is not eligible for both 80EE as well as 80EE. So it would never happen, that assessee is not having a house but only an home loan. Home loan is connected to the house. If the assessee sells the house, he'll have to first close the home loan. So practically 80EE and 80EE would not be available together for an assessee. Right, friends, so I hope you understood deductions. I've taken up all the sections which are applicable to your exam. We've done some practical problems. We've understood the deductions using those practical problems. Some of the deductions might come by way of an adjustment to a big problem. Some of the deductions can come independently. Something like a 80JJAA could come as an independent problem in your question paper. What you do is, when you read it, just try and apply some logic so that you remember it. 80G is one such section, which comes every now and then in a big problem by way of an adjustment. Calculating that adjusted gross total income would require a bit of a focus. You'll have to calculate adjusted gross total income only if deduction is in respect of item 3 and 4 that we have covered. These deductions, for all of these deductions, the definition of family is different. In some cases, even dependent relatives are covered, brother, sister, dependent on the assessee, it is covered. But then when you read it in totality, you'll understand that dependents are covered only in case of medical emergencies, like 80DD, 80DDB. Whereas in case of 80C, you would not see even a non-dependent child would be covered. So just read it in totality and try and understand the logic. You'll then retain it and probably you could apply it well in your exam. I hope I made myself clear. Thank you so much, friends. We continue tomorrow with a new chapter.